Hi, I'm Apurva Sheth and I welcome you to yet another insightful episode of The Right Choices with Oracles of Dalal Street. In our last episode, we were in discussion with JC Parets, who's the founder of allstarcharts.com. We were seeing how he analyzes the markets using his top-down approach to technical analysis. In the last episode, we've seen his perspective on US bond yields, how he transitions from bonds to currencies and eventually to equities. In this episode, we'll dive deeper into his style of analysis and look into greater detail stocks as well as sectors, and even get his perspective on cryptocurrencies and his style of trading and risk management. So let's begin this episode. So can you share some of your charts which you have made on the Indian market so that we can see what's the flavor like?
Sure. Well, one of the things that I'd like to point out is just how smart Bank Nifty has been. You know, when you go back to 2018, US financials were making lower lows, European financials are making lower lows, and Bank Nifty is making higher lows. It's like, wait, what? And then what happened in 2019? It was a great year. Bank Nifty was right. And then what happened last year into February? US financials making new highs, European banks making new highs, and then Bank Nifty is like, this does not look good. And what happened? Stocks crashed. Bank Nifty, right again, right?
Yeah.
So here we are with Bank Nifty making new highs. So what does that say about US and European banks? I trust Bank Nifty, So, I think US financials continue higher. When you compare regional banks, right? So when the market thinks rates are going higher, regional banks are going to outperform. And then there's less need for dividend investors to get their yield in stocks when they can go to the bond market. So REITs are going to underperform. So this chart should continue to do well. So anyway, so now we look at commodities, we look at interest rates. So then we get into the indexes themselves, new all-time highs for Nifty 50. We take an equally weighted Nifty 50. So instead of a cap weighted where the bigger names represent a larger weighting, if you equally weight it, you get a much more broad look, which is also making all-time highs, really confirming that. Mid caps, small caps, the Nifty 500, all making new all-time highs. It's really, really interesting. So here we're looking at the internals. So these are the percentage of Nifty 500 stocks that are above their 50-day moving average, turning higher. The percentage of Nifty 500 stocks above their 200-day moving average, right? So these are the internals that we look at. The advanced decline line as well, also turning higher now. So you can see that most stocks in India have been correcting since the beginning of June, right? You see that? There's been a massive correction underneath the surface. So if the advanced decline line starts taking off, I think that's positive.
Yeah, so Nifty was Nifty 500 or Nifty 50, both were flat. But the underneath, like if you see beneath the hood, then advanced decline line would have given you the indication that all's not well. And once that line started moving higher, so that's how you get into good.
Those are the market internals, right? Those are the market internals. And then we want to compare it to what's going on around the world. So here on the x-axis, we're looking at, these are all the countries around the world. The x-axis is the performance since February the 8th, which was the peak of enthusiasm in the market. That's when the new highs list peaked. That's when emerging markets peaked. That's when the SPACs peaked. Biotechnology, the IPO index, the new highs list, the advanced decline line on the NASDAQ, all of them peaked. So that's February the 8th. So the further to the right it is on the chart, the better it's done since February the 8th. And then on the y-axis, we're looking at the change from May 10th. So that is when the cyclicals peaked. Financials, industrials, materials, the New York Stock Exchange, advanced decline line peaked then. So that was like a secondary, lesser peak internally from May 10th. So the higher up it is, the better the country has done since May 10th. So that's how we're looking at that. So in other words, the further to the upper right, the better. The further to the lower left, the worse. And as you can see here, China, Peru, Kuwait, and then what's going on up here? India, Russia, Saudi Arabia, Canada. So a lot of the more energy-based, UAE, more energy-based countries obviously doing well, and then India. right? Just showing relative strength, pretending it's an energy-centric economy, which we are all well aware and know that it is not. So, you know, Bank Nifty, 46,000, why not? You know, look at Canfin Homes, nice base breakout. We're above the former highs from 2017. I think we're long. I think it continues higher. Look at ICICI Securities, 723. If we're above that, I think you stay long. Look at fast-moving consumer goods, just continue to do well. Nifty consumption, all-time highs. Take a look at United Breweries, right? Nice multi-year base. If we're above 1460, I like it long with a target up near 1900. So then we just go sector by sector, stock by stock. You know, Nifty IT, new all-time highs. What else is new? Right? This is what it does. If, you know, you wake up in the morning, you make new all-time highs. That's what Nifty IT does. Emphasis hitting our target. Look at Scient. You know, nice, beautiful base. If we're above 887, I think you own it. Persistent Systems continues to be very persistent. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It's like up every month for a year. Look at Tata Elxley heading towards 68.24. You know, in the autos areas, this has been struggling. It's more messy in the autos. You could see that in Maruti Suzuki, just messy overall. You know, take a look at Escorts. And like I said, Nifty Energy, just making all new all-time highs. Reliance obviously stands out. Nifty Commodities continues to do well, new all-time highs. Take a look at Solar Industries, 2280. I like that level. We're above 2280. We own it. Target up near 3200. So that's what we do. We just go sort of sector by sector, industry group by industry group, taking a look at what's going on underneath the surface. You know, Indian 10-year making new highs. You know, I don't think that's a bad thing. And then with respects to precious metals, you know, you don't need to be a CMT or a PhD to know these lines are going down. Right? These lines are not going up. So on the top, we're looking at silver relative to the S&P 500 making new lows, gold relative to the S&P 500 making new lows. And then when you look at silver miners relative to the S&P and gold miners relative to the S&P, all making new lows. So the only reason to own silver or gold, the only reason that people own it is because they must be looking at their charts with their eyes closed, right? Because these are going from the upper left to the lower right. Why on earth would you own that? So if you're buying these here, the bet you're making is that all of a sudden, out of nowhere, these lines are going to stop going down and they're going to start going up. That's the bet that you're making. Is that the bet that you want to make? Because the one thing we know about the market is that returns do not fall under a normal distribution curve, right? Markets are not random. Markets trend. We know that. That's why technical analysis works, because we're identifying the direction of primary trends, right? And that's what we see here. So we know that there's a much higher likelihood for a trend to continue in that direction than for it just to completely reverse. We know that. There are signs like relative strength, like momentum, like market breadth, like sentiment that help us determine if a trend is exhausted or if a trend is a new trend and something's just getting going. We have all of those things. None of them are signaling that these lines are all of a sudden going to magically stop going down and to start going up. There's no evidence of that whatsoever. Could we start to see evidence of that later today, perhaps? Or maybe later this week? Of course, anything can happen. But as we have this conversation, we have seen zero evidence that this is no longer a downtrend. This has been the worst trade in the entire world. You could have literally owned anything in the world and made money except for these rocks.
Yeah. So far, it's all equities and stay away from gold and silver.
I mean, until we start to see evidence that the trend is not down, right?
Yeah.
And like I said, that can be maybe later today, next week, next month, next year. Maybe it goes down forever. I don't know, right? I have all the time in the world. We could just be patient. We don't have to buy these rocks that nobody wants, right? Clearly, they don't want it for a reason.
Yeah, so it's actually very strange that all the commodities are moving higher. So you pick nickel, you pick any copper, you pick anything and everything is moving higher. But silver and gold, both these commodities, now gold I can understand that it's a it acts more like a currency rather than a commodity. But silver is also has an industrial use, but even silver is not performing. So it's pretty strange.
I mean, listen, I don't think there's anything strange about it. People are always telling me that silver, has industrial uses, but the market doesn't treat it that way. Again, it goes to stories and fairy tales. Like, maybe that's true. Maybe there are industrial uses for silver, but it obviously doesn't matter because silver trades with gold. It doesn't trade like nickel and lead and zinc and tin and copper. We know that. So we can tell each other all these fantasy stories about how silver has all these industrial uses and it goes to space and blah, blah, blah. We could tell each other those stories like if we were like little children that still need stories, or you can grow up and become an adult and understand that you don't need stories to go to sleep comfortably at night, and you could just see what's actually taking place. And what is actually taking place, it's not like my opinion. This is literally just math. Silver doesn't trade with base metals. No matter what the fairy tale says, silver trades with gold, trades down with gold.
Sure, absolutely. Yeah, so
and all the other commodities are doing well. I mean, gold is literally making multi-year lows relative to the rest of commodities. Nobody wants these rocks.
Yeah.
So now one thing which we are seeing frequently on your charts are those Fibonacci lines. So can you throw some light on them? How do you use them in your analysis?
Sure. Let me see if I can. Leonardo Fibonacci. So Leonardo Fibonacci was a mathematician, 900 years ago. He came up with the Fibonacci sequence. The Italians like to get all the credit, but actually Pingala, who is from India, in 200 BC, came up with this math before. Now, to Leonardo Fibonacci's credit, my understanding, he did not steal that from Pingala. They came up with the same conclusion through two different problems. Pingala came up with the solution through ways of speech, right? It was like forming sentences and like beautiful ways to write sentences. That's how Pingala came up with his Fibonacci sequence. In the case of Leonardo, Pingala obviously did not call it the Fibonacci sequence either because he wasn't born for another 1,500 years. But so Leonardo came up with a problem. How many pairs of rabbits placed in an enclosed area can be produced in a single year from one pair of rabbits if each pair gives birth to a new pair each month, starting with the second month, right? That was the problem. So what do we know, right? We know that each pair, including the first pair, needs 1 month to mature. So this is the number, right? Right here. This is it. Right? So we know in the first month we have 1, right? But because the rabbits need 1 month to mature, in month 2, we still have 1 pair, right? And then in the second month, the pair doubles, so now you've got 2 pairs, right? And now moving on, we have a third pair, right? So it goes 1, 1, 2, 3, 5. And then how it ends up working is that if you take any 2 numbers next to each other and you add them together, that gives you the next number in the sequence. So 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, 5 plus 8 equals 13, 21, 34, 55, and so on. So the answer is, after 1 year, how many pairs of rabbits do you have? The answer is 144. But that's not so much. But when you divide one number by the next number in the sequence, you're always going to get 0.618. So if you take 34 divided by 55, you're going to get 0.618. If you take 610 divided by 987, you're going to get 0.618. If you take 233 divided by 377, you're going to get 0.618. That's the golden ratio. So when you have a market correcting, right, selling off, when you get a bounce, that first target is going to be 61.8% of the entire decline, right? The market tends to respect those levels quite often, right? So here's a great example. This is JP Morgan. In 2011, here's your rally after 2009 lows in JP Morgan. And where did the correction end? at exactly the 61.8% retracement of the entire move higher. Look at Chevron. Here's the low in 2003. Here's your high in 2014. And where did the correction end? At exactly the 61.8% retracement of the entire move higher. And then let's talk about extensions. Let me see. Where's the math? Do I have the math? Let's see. Here you go. So if you look at the entire Fibonacci sequence, when you take any number and divide it by the one on to the left, you're going to get 1.618. So 89 divided by 55 is 1.618. 377 divided by 233 is 1.618. 2584 divided by 1597, I'm not going to use a calculator. I know it is 1.618. Right? So when a market corrects and retraces 100% of that correction, that's 100% retracement of the correction. When we break out and make new highs, that next extension is the 161.8% of this entire decline, right? We see it time and time again. Here is the explorers and producers. High in 2011, here's your low. Where did explorers and producers stop going up? At the 161.8% extension. I was just going to say, here's another example, right? High in Tesla in 2014. Here's your low in 2016. Here's your breakout. Where did it stop going up? 161.8% extension. So we see these time and time and time again.
Yeah. So a lot of times when stocks go into uncharted territory, that's when Fibonacci extensions would help you a lot to identify your support and resistance levels.
Yep, that's right. So extensions and uptrends, retracements and corrections.
So JC, apart from this, you have also been very vocal about cryptos, and a lot of people are also interested in knowing about cryptos. So can you share a few of your charts? I know Bitcoin and Ethereum both are breaking out or about to break out of their new highs. So can you throw some light on them?
Yeah, we've seen just Bitcoin dominance, the relative strength. Speaking of relative strength, this is the chart of Bitcoin market cap relative to the market cap of all the other coins. And we've seen a huge bounce from last month's lows. So I think this is the chart that we want to look at. This is an equally weighted chart of the top 5 cryptocurrencies. So we're looking at Bitcoin, Ethereum, Ripple, Binance, and Cardano, equally weighted. So these are the 5 biggest in the world. And if we start to take out these former highs, I think that, we are in for a serious bull market. And if you're looking at Bitcoin relative to the S&P 500, if we're above that former peak high, right? The academics will tell you that the correction in Bitcoin versus the S&P stopped at the exact place where it peaked in 2017. They will tell you that that is a coincidence. And it's in their jobs as academics are dependent upon that being a coincidence, because they teach the efficient market hypothesis, which is an absolute joke. So your parents are paying for these college professors to lie to you. Never made any sense to me. Speaking of not trusting people and only trusting price and dogs. And then look at these bases. Cosmos, Avalanche, Algorand, Elrond. These are massive bases that have been taking place all year. So if you want to buy the altcoins, I think that if we're above the former highs, I think you could be long. If we're not above the first half highs, I don't think you could be long, right? There's other places to be. I think you're better off being patient. But if we're above those former highs, I think you can own these things. So that might happen this week.
Okay.
Sure. So I think this has been a complete power-packed conversation. Like you have shown us how you go from US bond yields to various indices globally, and then you pick your stocks and sectors. And we have also discussed a bit about Bitcoins. Now, I know that trading or identifying entry points is just one element of trading. Apart from that, you also need to manage your risk and stop loss is one thing which helps you manage your risk. Now I'm sure there are many other things that you would recommend and you would be doing as well. So can you show or can you share some insights on in that?
Yeah, and for me, risk management I think it starts with position sizing, right? Not being too exposed. I think if you're having trouble sleeping at night, you're probably too big, right? And then also identifying where you're wrong before you get in. Because once there's money on the line, once you have risk on the table, your emotions start shooting higher. It's perfectly normal. Very, very, very natural. But when your emotions are elevated, you don't make good decisions. You can't think rationally. You're thinking emotionally. So in order to overcome that, because the reason people lose money has nothing to do with the Federal Reserve or the TV. The reason they lose money is because of themselves, right? It's your own fault. You have to own it. So, and it's because when there's money involved, we get crazy. So in order to eliminate the crazy out of the equation, if you predetermine where you're going to be out before you get in, you take your craziness out of the equation. So, and not like 5% arbitrary trailing stops or 10% arbitrary trading stops. That's a terrible idea. You want to identify what the market would need to do to prove your thesis invalid. So if I'm buying a stock at 100 and there's resistance at 95 for like a year and we're above 95, the trade is I only want to be long if we're above 95. So if we break below 95, I'm wrong. I have to move on to another trade, which is fine, right? That's fine. We know that. So now when it breaks below 95, I know what to do. I get out of the trade. I had already made a plan and I stick to that plan. Now, what if we hold above 95 and it goes up like I think it is, and I have a target of 130 because of Fibonacci extension or whatever? When it gets to 130, I know what to do. I'm going to sell it because that was my plan, right? So you want to have a plan before you enter the trade. What does the market need to do to prove you wrong? And where do you think it goes where you're going to take profits? Those levels need to be identified before you get in. So then that's where position sizing comes in. So you don't just have random position sizing. You don't just put random stop losses. You identify where the market proves you wrong. And then based on your entry point and what that level is where the market proves you wrong, let's say it's $5 a share. So then if I'm willing to risk 2% of my portfolio on this trade, right? I take the entire value of my portfolio. Let's say it's $1 million. 2% of that is $20,000. So I take $20,000 divided by that $5 a share, and that's how many shares I need to buy to be able to express that thesis in the market based on my specific parameters and time horizon and overall objectives. Maybe you're willing to risk 5% of your portfolio, and on $1 million, that's $50,000. And you divide $50,000 by $5 a share, and that's how many shares you should own. Me personally, I don't like risking more than 2%. Maybe you want to risk 10%. Maybe you only want to risk 1%. So the math is going to be different for all of us. The formula is the same. The formula is the same. The math is different based on how risk averse or risk on you want to be.
So this is the golden rule of position sizing which every trader should follow.
I mean, that's what makes the most sense to me. And by the way, I didn't make that up. I've learned that from the best traders in the world. That's how they do it.
Yeah, absolutely.
So, I mean, it's not like I didn't make up this formula. I mean, it makes perfect sense when you think about it. But people don't like to think.
So that's a good piece of advice for all our viewers. Now we have come to an end of our conversation. Now we have a small section where we ask a few rapid fire questions. So I'd like to ask a few questions to you as well. So what is the most favorite book that you have ever read?
My favorite book that I have ever read. Wow, it's a good question. I've read a lot of books. Listen, this is a podcast about the market, podcast about technical analysis. Edwards and McGee, technical analysis of stock trends.
So the classical book on technical analysis.
What do you want from me?
And what are you watching these days?
Well, I just showed you energy, interest rates. I think that is the big theme. If energy and interest rates are going higher, we got to be buying energy stocks. We got to be buying financials, bank stocks. Yeah, that's number one on my radar.
What's the most memorable day of your life?
The most memorable day of my life is the day my daughter was born, July 22nd of 2020.
And one life lesson that you'd like to share with all of us?
Just keep an open mind. You don't have to be so stubborn. People rather put their ego ahead of making money. We're not here to be right. We're only here to make money. That's the only reason you're in the market. You're not in the market to be right. You're only here to get paid. And if you're in the market for any other reason than to make money, you are very confused and you should seek therapy. You're in the market to make money. That's it. You're not here to be right. So people are like, oh, my stock's going to come back. My stock's going to come back. No, it's not going to come back. Get out. Rip off the Band-Aid. Move on.
Yeah. So be flexible and humble.
Yeah, be humble, or the market's going to make you humble.
Make you humble, yeah. Okay.
So that's it for today. I think it was a great conversation with you, and I'm sure a lot of our viewers would also find it insightful the way I've done it. So thanks a lot for giving us your time and sharing your insights with us. It's absolutely amazing to talk to you.
Happy to do it.
So in this entire conversation with JC Parets, we have seen how he uses the top-down approach to analyze the markets. So he begins his analysis with the US bond yields, which is the fountainhead of capital which keeps the global financial system running. He then moves on to currencies and eventually to equities. Within equities, he uses relative strength on an extensive basis to find out winners and laggards in this basket. We have also seen how he uses Fibonacci retracements to identify support and resistance levels. We have also seen his perspective on cryptocurrencies and gold and silver as well. Now, I'm sure that you would have found this episode truly insightful. In case you did, then please like this episode, share it with your friends and family members, and do subscribe to our channel so that you don't miss out on any of these insightful videos that we come out on a regular basis. Thank you.
काफी कुछ चेंजेस ऐसे, जैसे अभी सडनली एक शिपिंग इंडस्ट्री में $1000 का रेट चल रहा था, वो सडनली $6000 हो गया. सो दिस इज अ काइंड ऑफ अपॉर्चुनिटी जहां हमको दिखता है कि प्राइस स्पर्ट आने से अगर वो शिपिंग सेक्टर में भी कोई पेनी स्टॉक होगा तो अच्छा खासा वर्किंग करना चालू कर देगा.